Welcome to these audio slides on the goals of rational managers with irrational investors. My name is Manfred Frühwirt. I am Professor of Finance at WU Wien, which is Vienna University of Economics and Business. The purpose of these audio slides is to illustrate what goals rational managers can pursue if they are facing irrational investors. Baker et al. 2007 distinguished between three different goals. The first goal is increasing the fundamental value. This is the normal goal, well known from neoclassical finance. Here, the managers try to maximize the fundamental value, which is the shareholder value. And this can be calculated as the present value of future free cash flows or future dividends. So here, the managerial decisions focus on the creation of shareholder value. Examples are: the managers should perform an investment project if the NPV is positive, and the managers should terminate an investment project if the remaining NPV is negative. This is called the option to abandon a project. Now, in behavioral finance and in reality, the price of a security often deviates from its fundamental value. For instance, there is the phenomenon of excessive volatility. And this gives room for two additional goals. Goal number 2 is the market timing goal. Here, with their financing decisions, the managers try to exploit temporary mispricing of their own securities on the financial market. So if their own securities, for instance stocks, are underpriced, which means the price is less than the fundamental value, then they are repurchasing their own securities. If the own securities, for instance stocks, are overpriced, which means the price exceeds the fundamental value, they will issue their own securities. What is important is that market timing requires that the financial market does not immediately react to the announcements of the security issues or repurchases. So there must be a window of opportunities where the company can issue overpriced stocks or repurchase underpriced stocks. Altogether, market timing does not change the fundamental value of the company, because the fundamental value only depends on the asset side and not on the liabilities and equity side. Market timing clearly goes at the expense of those investors who buy the newly issued securities, like stocks, at a too high price, or at those investors who sell securities, like stocks, to the company below the fundamental value. Those guys who are winning are the long-term shareholders who do not participate in these capital transactions. So altogether, market timing means a reallocation of wealth between the different shareholder groups or stakeholder groups. And this reallocation materializes as soon as the price converges towards the fundamental value. The third goal is catering. Here the managers try to generate or intensify an overvaluation of the stock on the capital market. The shareholders are considered as customers to whom the financial managers want to sell the stocks. And the managers provide to the shareholders a characteristic that currently is highly demanded and for which the shareholders currently pay a premium, even though that characteristic does not necessarily increase and often even decreases the fundamental value. So here the managerial decisions are tailored to the current taste that is motivated, for instance, by psychological biases and heuristics, to the tastes of short-term shareholders in order to push the price relative to the fundamental value. One example is managers who pay out high dividends simply because the shareholders like to get high dividends, which can be seen from higher prices of dividend-paying stocks, even if that dividend policy maybe has no or even an adverse impact on the fundamental value. This could be because of taxes. Another example is managers who perform a certain type of investment projects only because the shareholders consider them as positive, even if they are not positive. Another example is, as you know, in 1999 there was a strong high-tech bubble, and as a result of this, managers of many non-IT companies changed the names of their companies into .com, often without even changing their business models. Due to this, the stock prices went up massively, on average by 74%, but then the .com bubble burst, and all the stock prices fell sharply. As a result of this, many firms eliminated the .com from their names, and again the stock price went up by 70%. There was a very similar example in 2017 when we had the Bitcoin bubble. At that time, some firms changed their names into blockchain, again without changing their business model. For instance, there were iced tea producers, juice producers, or sofa producers who did this. The result again was that the stock prices increased massively. Altogether, we can say that catering is rather creating price instead of creating value. Often, the managers even reduce the fundamental value in order to push the price of the stock. The problem is that sooner or later, the price has to converge to the fundamental value. So the price effect is only a short-term effect. So far for these three goals, let us look at the relationship between these goals. In neoclassical corporate finance, the price always equals the fundamental value because we have an efficient capital market. In this world, these three goals collapse into the goal increase the fundamental value or maximize the shareholder value. Timing the market is not possible because the price always equals the fundamental value. Pushing the stock price above the fundamental value is also not possible. In reality, the price may deviate from the fundamental value. Therefore, we have these three goals. Now the question is, which goal do the managers pursue? And this very much depends on the horizon. If we have short-term oriented managers, they will rather look at the price and ignore the fundamental value. So for them, the catering goal will dominate. If, however, we have long-term oriented managers, they can afford to ignore the price and focus on the fundamental value. Because on the long run, the price has to converge to the fundamental value. So in that case, the goal to increase the fundamental value will dominate. And they may pursue the market timing goal in the interest of their long-term shareholders. Of course, there's a very strong link to the incentive system. If you pay your managers based on short-term incentives, you will create short-term oriented managers. And as we see here, short-term oriented managers will rather pursue the catering goal. This may even lead to a reduction in the fundamental value. This is the problem of short-termism. So far, for these three goals that rational managers may pursue when they are facing irrational investors. I hope you enjoyed these audio slides. Thank you very much for watching.